if you publish bearish stuff, people love it. And if you publish optimistic stuff, you don't get as many clicks, you don't get as many subscribers. And that's an empirical fact that, human beings respond to negative news and buy negative. Like if they do an A/B test of two magazines and one cover is positive and one's negative, the negative one sells more. So like people want to hear negative stuff all the time. And so I think that's probably the biggest bias in finance is the financial media, the mainstream media, individuals, Twitter, wherever you go, there's just way more negativity. And then that creates, a lot of people being underweight stocks when stocks are going to all-time highs and all that kind of thing.
Welcome to the Rose Show podcast. Thank you for joining us. Today, I'm here with Brent Donnelly. He is the author of Alpha Trader, as well as several other books. He's been trading since 1995. He's an expert FX trader, so we're going to be learning about some currency trading from him. He's also president of Spectra Markets, where he has Spectra School, and he helps bridge the gap between theory and real-world trading. And he publishes independent work on global macro trading analysis, as well as FX trading. So grateful to have you here today, Brent. How you doing?
I'm great. Thanks. That was a pretty sweet intro. If you want to work in marketing at Spectra sometime, send me your resume.
I will do. Thank you so much for that. First thing I want to ask you, I have to say, when I first noticed you on Twitter, you have this really cool handle. It's like an upside down of your name. And I have to ask you, how did you get that?
So yeah, I was thinking about like my brand, I guess, has always been like professional, but not totally boring. Like I'm trying to be professional and like use data and be intelligent when I write and all that, but also not be boring because I don't know. I don't want to read boring stuff. So I don't want to produce boring stuff. And so I was trying to think of a way to communicate that like this is a serious place with my communication, like putting serious global macro heat maps and all that stuff, but then like a nod to, but like we're not taking things too seriously here. So I don't know, I just was looking for weird fonts because I thought have you ever seen the fonts where like the letters are dripping down or whatever?
Yeah.
And then I thought, oh, that's too much. And then I thought, you know what, human beings can read upside down if they try. So I just like that. And I thought it kind of signals that we're not going to totally take everything all that seriously, but we are serious.
I love it. Well, it's very cool, unique, and it definitely has some flair to it. Very catchy. So thanks for letting us know. So I want to know how it all began for you. You've been trading since 1995. I mean, that's a long time. And you've been, you're obviously been around, you've been successful. It takes a lot to be around this many years and FX trading as well. How did it all begin for you, Brent?
So yeah, it's getting a little bit mind blowing now, and people will learn this as they get towards 50 years old, that the amount of time in the rear view starts to be mind boggling. But anyways, I grew up in the time of Wall Street, the movie. So Michael Douglas and Bud Fox and all that. And then I grew up kind of like lower middle income, I guess. Like we had what we needed, but like I wasn't going on the field trip where you had to spend $100 to go on the field trip kind of upbringing. And so I think I saw money as like a way to get out of Ottawa, Canada, and like lead a different life. My life was fine, but just like lead a different and more exciting life. Then I saw Wall Street and I'm like, ooh, those guys make a lot of money. And then I read Liar's Poker. And then I started thinking like, okay, this is what I want to do. This is super cool. And the irony really, and Reminiscences of a Stock Operator is another book that I read at that time. And actually, if you know about those three works of art, all three of them are cautionary tales, basically telling you like, don't go to Wall Street. It's a corrupt and dangerous place. However, you don't know that when you're 16 years old, and I'm happy that I got here. So that was kind of the initial impetus, was like, I want to do something where I can be excited and make money and get out and, see the world. And that seemed like a good way to do it. But then my interest was always in like puzzles and games and things. So it's a very natural fit to go from that to markets. Like people that play like Magic the Gathering or poker or those kind of things tend to be good at markets because there's a lot of similarity. And so it was a pretty natural fit for me. And then over time, so then I went to business school and then I went and started trading. And over time, I guess essentially there was always a part of me that was creative and that liked writing. And so over time, that has become an important part of what I do as well. Initially, the reason I wrote was I would sit down at the FX desk as a market maker and I say I'm trading euro. I'm the market maker in euros. And there'd be 15 salespeople, and one by one, over the course of 2 hours, they would all call me to ask me what I thought. Like we had like a little hoot button or whatever, like doo doo. Hey Brent, what do you think of euro today? I'm like, this can't be the most efficient way to do this. So I would write like a tiny email in the morning saying, here's what I think about euro. And then this is like 2003 or something. And then a couple of people would say, oh, can I send this to a client? This is interesting. And then I'd be like, well, it doesn't look very good. Let me throw a chart in there or whatever. And then more and more people were sending it to clients. So I'm like, I guess I better make this like actually seem smart and interesting. So then I just very gradually kept improving it over time, like tiny changes. And so now that's a product that I've been writing since it kind of became like a product in 2005, I guess. So it's a product that I've been writing for whatever that is, 19 years, and it slowly kind of evolves and adapts over time. And just to kind of finally answer the question, because I know this is getting kind of long answer wise, the other thing I think that helped me is not just trading and writing, but also just adaptation in general. So that was one adaptation that I did. But I think in general, I'm pretty adaptable because I'm just not that dogmatic. And we had spoken ahead of before the show started about like worldviews and dogmatism and things like that. And I don't know, I just see whatever I see, and I'm not all locked into a particular worldview generally.
Well, that's definitely some successful trading ideas and thinking right there, being flexible and always adapting, changing your theory and your outlook based on new information and not remaining dogmatic and stuck in any one view. So excellent points there. Pattern recognition, I think, is key, and you've certainly done that over the years, and watching these cycles as they played out, and they tend to rhyme because they're based on human emotion. It's the FX part that gets me. I think that's a very complex type of trading. It involves having to understand, geopolitics as well as other countries in comparison to ours, because it's not like one currency exists in a bubble, it's against another currency. So
Mhm.
how did that evolve? Have you always been into, global studies, or how did you get involved with the actual currency trading?
So it's kind of the distinction between micro and macro in a way. And I always like macroeconomics better than micro. So I was envisioning myself as a tech analyst, reading balance sheets and income statements for the same company every quarter and slicing and dicing them. And like, obviously, that's not exactly what a technology analyst does, but it's not that far off. And so I always thought that I wanted to do something more macro. But think about when I was starting, I was 20 years old. Like I knew nothing. So there was, unlike today where they have these sort of complicated rotation programs where you sit on many desks. When I started at Citibank in 95, I went there and I said like, hi, I'm here. I want to be a trader. And they said, okay, sit on the structuring desk for a couple hours, the T-bills desk for a couple hours, which is like money market desk, and the FX desk, and tell us what you think. And like structuring is much more cerebral and slow. T-bills is like not what I wanted to do. That's not a flow business. So, and FX was like, this is it. This is my dream. So I think there was quite a bit of randomness involved. However, if I didn't like it, I'm the kind of person, if I don't like something, I just switch or move on. So if I didn't like FX, I would have moved on. And what I like about it is, so people will say like when COVID happened, oh, like disparagingly about macro, oh, we're all vaccine experts now, or we're all, Israel experts now, or Hamas experts now. And I think that's the wrong way of looking at it, because what you are actually is just someone who understands how that factor impacts your market. So like I'm not an expert on Hamas or Israel or COVID-19 vaccines, but I know if there's a vaccine approved and it's going to have 95% of efficacy in theory, the market's going to react a certain way in my currencies. And that's kind of how I look at it. And so I actually just go and look for experts on the things that I think are relevant. So if people are worried about Iran or Saudi Arabia or whatever, then I'll find who are the experts on that. I'll get their analysis, and then I'll make some kind of subjective judgment of like, okay, this matters for the dollar or it doesn't matter for the dollar. And so I think that sort of derogatory like view of macro, which is it's joking around, but I think jokes often have a lot of truth in them. And I think it's misguided, because really that is what macro is understanding how different factors impact your thing and then trading that thing and making money. And that's what I like about macro, is that it's very, very different every year. Like sometimes you're worried about twin deficits, sometimes you're worried about COVID, then you're worried about current account balances and valuation of currencies, interest rates. Like which is a thing that drives people crazy, is that it's not always the same thing driving currencies up and down. So that's something that drives people crazy, but that's something that it drives me crazy, I guess, in a good way. I like it.
Sounds exciting. It's never boring, certainly, and it's always changing with many moving parts. And it's
Mhm.
not necessarily as easy to predict. There's always so many changing patterns, so we have to adapt. Definitely exciting. I love macro as well. You seem very resourceful, getting all the different information, finding the right places, and then making your own decisions based on that information. So, I want to start with macro. Might as well just start with macro. And
Sure.
let's talk with macro. I want to begin with an overview, and then we can get into the data, leading versus lagging indicators, soft versus hard data. But overall, your view. I believe I read somewhere that you were saying something about maybe we're in a secular stagnation pre-COVID period that's now continuing. But let's throw in some inflation in that.
Mhm.
And let's see where we're at. We're in the threes right now. And then this massive debt, fiscal spending to no end. What are your thoughts on all of that?
So one caveat just before we start is generally people have different time horizons. And I think it's really important to know what your time horizon is. And my approach is I trade pretty short term, but in the context of the big macro picture. So what I'm looking for is like mispricings, like, okay, 6 cuts are priced in for the Fed, but the economy's doing well. That looks wrong. Or now we basically have had, it's changed a little bit lately, but yet almost nothing priced in for the Fed. Yet the economy's slowing. Clearly, its demand is lower to me clearly now versus January. So those are interesting setups where I'm always looking not just like what is the economy doing, but where is the pricing relative to what the economy is doing and relative to where I think it's going. Because there can be situations, which is a common thing for me, where it's like, I think we're in a soft landing environment and now the pricing reflects soft landing. And then it's like, okay, well, maybe there's nothing to do right now from a trading point of view. So, but going back to your initial question, I do believe the baseline that was set by the secular stagnation, like 2010 to 2019, which was kind of like disinflationary, blah, caused by technology and demographics. Sorry, technology and demographics, kind of creating a downward pull on inflation. I don't think that's gone away, but what I think has happened is you kind of got this like massive reset after COVID, and now we're very, very slowly mean reverting back towards something that will never be as stagnant as secular stagnation was. So I think we're kind of stabilizing at slightly higher inflation levels. Like say we stabilize at 2.7, 3.2, something like that, on the various measures. And I don't really think the Fed cares about that. And the backdrop of the size of the deficit, and the comps from prior years, and then flexible average inflation targeting, which kind of was supposed to be like, hey, we had really low inflation, so let's have a little bit of extra. Obviously, careful what you wish for, and then you get 10% inflation. But I think generally what we're going to do is very, very slow mean reversion back to something that looks a little bit like 2017, 2018, but a little bit different because the whole world broke in 2020 and now it's all kind of it exploded, and then you imagine it all coming back together. The pieces aren't all going to come back together exactly the same, but I'm not particularly worried about like wage price spirals or even like another extreme reacceleration in inflation. I just think that we're mean reverting now very slowly, and that last mile from 3% to 2% is difficult, but I just don't think the Fed really cares. I mean, look what Bank of Canada and ECB are cutting, and inflation's way above target in those countries as well.
Refreshing point of view, I have to say. You have a lot of people on the show, and I've spoken, and you read about economists tend to be very, one thing about economists, they all vary in their opinion. It seems that it's very difficult to find two that completely agree. So it's refreshing to hear you speak, Brent. Now, let's just take the inflation. Let's start with that element of the discussion. Now, do you think threes are the new two? Do you think that we're set for a higher inflation? I know you said it's not going to aggressively reaccelerate, but do you think we're going to coast around this level? Because it is significant, especially for small businesses and for the people, higher prices. Do you think we're going to be in this level because of the massive increase in the money supply during COVID? I think it was $5 trillion. You think it just will take time to come back down? Or will we ever go back down?
See, I don't think we'll go as low because of, like you said, so much more money has been released into the economy. Although, that's more a rate of change thing. And obviously, as things slow, inflation can slow, even if there was a lot of money in the economy. But at the same time, there's been some permanent changes in terms of psychology around wage growth, psychology around price setting. And so if you think about, like, say, 2019, I live in a small town in the United States, and the restaurant prices were exactly the same from 2010 to 2019. They might like move it up a little bit or go from $12.99 to $13.99, but they always, and if you worked at a school, what they would do is increase tuition, like a private school. They'd increase tuition by 3% and teacher salaries by 2.5%, and everything was kind of like this crawling thing. There was really no thought process. It was basically an automatic 2% or 3%, everything went up, and that was it. And then after COVID, now business owners are like, how much can we charge for this thing? Maybe we can charge more. Oh, our volume went down 10%, but we increased our price 40%. That's a win. Let's do that. So the psychology around price setting completely changed, where people are just now being creative about it and saying, okay, how much can we charge? If we lose 10% of our volume and we increase prices by 25%, that's great. That's a great thing for the business. And it might suck for society, but it's good for the business. So I think that change in mentality just means that price setting has changed, especially with now there is a ripple effect in wages from inflation as well, where people will say like, okay, year over year inflation is at 3%, but yet still prices did go up 20% in 3 years or whatever it was. So people don't, like, economists and PhDs will say, yeah, but year over year is back basically to where it was. But human beings don't feel like that. They just feel like prices went up crazy amount and they're still going up. And so if you have any negotiating power, you're going to ask for wage increases because, hey, my auto insurance went up 22% this year. So I think that psychological change, it's actually similar to Japan, where you almost had like this societal structural thing where inflation and wage gains just weren't even an idea that was in people's heads. And then now it's just in people's heads. So even though you're not going to get a 10% raise, you can still reasonably go in if you're a good employee and say, hey, like, look what prices did. I need at least 5%. This is ridiculous. And so I think that will keep prices, or keep inflation a little bit more elevated. But then you still have the bigger, so those are cyclical things, and the structural things are still there, like technology and demographics are just not inflationary.
No, well said. Yeah, technology is actually deflationary, and with AI, I think there's a lot of opportunities and a lot that's going to be affected. It'll help bring down, hopefully, a lot of these prices. So yeah, psychology is everything. Market psychology, and you talk about that in your book extensively, and we're going to get into that. But psychology with inflation as well. Great points there, Brent. What about this debt? massive debt. Of course, it's all over the place. Everyone's talking about this spending, high interest expense, over $1 trillion a year, debts reaching 35 trillion. What are you thinking about all that? Or is the debt insolvent, like some people say? Is it leading to monetary destruction? Will it further fuel inflation? What are your thoughts on this?
So a little tiny bit of all of the above, but I think I tend to be a little bit more jaded on this topic because this entire conversation was happening in 1985. So the clock went up in Times Square in 1990. It's still up there. I mean, it's like falling apart. I don't know if everyone knows what that is, but the Times Square debt clock is still there. It's been there for 35 years. A friend of mine was in the business in 1985 or 80, I think it might have been 86, when the US first became a net debtor. And so this guy was like 25 at that time, and his boss was 50. And his boss turned to him and said, you know what, dude, the United States is screwed. We're a net debtor. We have no way of funding it. And this was in 1986. So I'm a little bit jaded. And then I think a mistake that people make in looking at this is to look at nominal numbers and say like 1 trillion, et cetera. The numbers are just not that meaningful unless you have some context. So if you look at interest payments as a percentage of GDP, that's like a pretty good way of normalizing. And they're going up like in a way that I would say, like, wouldn't use the word alarming, but they're going up pretty fast, obviously, because interest rates are going up. But the amount of interest that the US is paying now as a percentage of GDP is a lot lower than it was in the 80s. So on that metric, you could say it was much worse in the 80s, but then the absolute numbers obviously now are just absolutely mind-boggling. But absolute numbers essentially mean nothing. So I think it's important for people to always normalize based on GDP or based on cost of servicing, because again, the size of your debt isn't really the thing that matters, whether you're a company or a country or a person. It's the size of the debt and times the interest rate relative to the amount of production or income that you have, right? So the thing that people never ever say is, well, look at the value of all the assets in the US. So not that the government has a claim on those assets, but the deficits are going up at the same speed as household net worth, basically. So it's not like this debt is going up in a vacuum. The thing that's happening is the debt is going up and the assets are going up. So if you look at Google's balance sheet, let's just say someone tells you, okay, Google has debt of $5 billion. It's the highest Google's debt has ever been in the history of Google. You're not going to say, okay, well, Google's bankrupt. That doesn't make any sense. You'd say like, okay, what's their revenue? How many assets do they have? Oh, they have 50 billion of assets and 5 billion of debt. Okay, that's not as scary. So I think when you look at everything in context, the deficit and debt story is bad, but it's not as bad as it looks. But the reason I do think it's actually going to be bad is that the politics are so skewed towards spending money now that it's a complete joke. So there used to be a thing, and eventually this is what, like in the Clinton era, they ran surpluses because people eventually said, this is stupid. We can't just always spend more than we have, or there has to be a release valve, right? The release valve is either weaker fiat currencies or higher bond yields or something has to happen, higher inflation. So in the 80s, people got scared, and then the bond vigilantes came, and then Clinton balanced the budget and everything was fine. And the 90s were the best decade ever in the history of human life. But now the politics are so crazy. So it used to be always, even in 2013, you'd be, okay, we're going to do this new spending thing, or we're going to do these tax cuts. And then someone would say, how are we going to pay for it? And like even the Bush tax cuts or whatever, they always gave some absolute like BS way that they were going to pay for it. That was never true, but always, at least they were like faking, or they were pretending that they were going to pay for it, even though they knew they couldn't. Now that nobody even asks that, right? It's just like the TCGA that Trump did, and then the COVID stuff that Biden did. It's all just like, we're writing some numbers on a napkin and we're going to spend this much and like, see you later. And so to me, because that's an easy way to get votes. And I think like the entire society now is predicated on pain avoidance in every sector of society, that no one's ever going to say we need austerity. No one's ever going to say the government should spend less. So I actually do think it will be a problem. However, the time horizon is a major thing. So like I said, there's people that bought gold in 1982 because of this. Jim Grant, actually, I was talking to recently, and he was saying that he was going through all these kind of same conversations in the 80s, and was people were lining up to buy gold to protect themselves. So I think it's something that like is fun to be scared about, and people love dystopian stories because like, you know, look at how much dystopian fiction there is and all that. People just love dystopian stories of, you know, Zimbabwe and Weimar Germany and all that kind of stuff. But these things can go on for so long that I just feel like the only implication to me is that it's debasement of fiat currencies, which means higher stocks, higher Bitcoin, higher gold over time. And that's a structural thing, but I'm more of a cyclical guy. So I think structurally there's going to be more money and fiat will be devalued over time. And but the big mistake people make intellectually is to think that that's bearish. It's not, it's bullish.
Great points there. It's about time frames, like you said earlier,
Mm,
and it's not something that we like talking about it because as humans, we just, I guess, enjoy that scariness element
mm,
there. But it's not something that's happening the next year or two. And I know you're a short-term trainer, and the opportunities, the tactical opportunities, are here in the short term. You play the cyclical trends. And so it's not something we need to really be concerned about, but we enjoy talking about the doom and gloom of that. And like you said, everything's relative, and it's important to compare things. And you do that in economics. You got to, having a number in absolute doesn't really mean anything, but you need to compare it. And then what you said earlier will be the segue into the next question: expectations versus actual. And it's so
mm.
important in economics. It's like you always value something with how the expectations are, like the expectations of inflation. Milton Friedman spoke about that as well. And so let's go with expectations of these rate cuts. Okay, we had 6 or 7 of them, I think, priced in for this year. Then it went down to 3. Now I don't even know. I've lost track. So what are your thoughts on rate cuts in 2024? Here we are in June. We have Bank of Canada did a cut. They have inflation, I think, over 3%. Then ECB today just cut, and they have accelerating inflation, and I think 8 euro area, this more than anyone. I think 8 euro area countries have inflation still over 3%. What do you think the US may do? And will they follow suit?
So the first part of this conversation, I think that people should think about is it doesn't matter to me what they should do. So like whether I think rates should go up, down, or sideways, I never try to keep that, or I try to keep that out of my thinking and out of my analysis, because I think generally people have a bias towards being more hard money, and you know rates should generally always be higher and currencies should be stronger, and people just tend to believe that philosophically. But if you put yourself inside the Fed, what they think is that there's a neutral rate somewhere and it's hard to observe, but we know it's not, it's way below 5. So some kind of the neutral rate would be the point at which you're not accelerating. Once you hike rates above the neutral rate, you're not allowing the economy to accelerate, is sort of the basic way of thinking of it. So they think that that Fed funds is way above neutral and it's in restrictive territory and inflation's falling. So you can't wait for inflation to get all the way to 2 before you cut, or you're like squeezing the air out of the economy for way too long. So forget about whether that's true or not, because half of the stuff that the Fed does, I don't believe, but it doesn't matter. So that's what they believe. And so through that lens, and this, all the central banks use the exact same philosophies and, you know, are reading from the same Bible kind of thing. So they all believe that they added insurance hikes to make sure that the inflation didn't fly out of control. And now inflation's under control. So we're going to remove the insurance hikes. So that's the context. And that means that at the first whiff of anything soft in the US, the Fed will cut. So inflation lower enough, unemployment rate to 4.1%, which to me could happen in like the next 3 months. There's a lot of scenarios. Like if you plot out, if you did like a Monte Carlo simulation or something, there's so many scenarios where they cut, and there's like basically none where they hike. There might be one where there's another supply shock for some reason or whatever, but the distribution is essentially 0 hikes to 7 cuts in the next, say, 12 months. And then you're trying to figure that out. So in terms of pricing and trying to make money, every time you get close to 0 in terms of cuts, there's a really big asymmetry there because they're not going to hike, or it's very unlikely that they're going to hike. So then that presents an interesting market opportunity, because the other thing is that if they start cutting, so there's 2 things you need to figure out: is when do they start and how aggressively do they cut? And there's always going to be this scenario where something really bad happens, stocks go down 20%, earnings roll over, whatever, and they cut 50 basis points 3 times in a row. So there's always going to be the possibility of big cuts. And then there's the second possibility, which is like 1995, where it's like, okay, inflation's fine, we don't want to be too restrictive, let's get back to neutral, and they cut 3 times. But there's really no situation where they're like hiking in 50 basis point increments at this point. So there's a big asymmetry. But the problem is that it's like Tesla fully self-driving. It just keeps on getting punted. Like it's always coming. The rate cuts are always coming, but then you get there and they're not there. You know what I mean? Like they were going to cut in January, then they're going to cut in March, then they were going to cut in June. And that the pricing just essentially keeps on moving over. And like I was saying, like self-driving Tesla, like in 2015, they said it's coming in a year, and now 2016, 17. So it just keeps on moving over. But when they start cutting, it could be pretty dramatic. So I feel like playing for cuts again now it makes sense, because under the hood, I think the data is starting to weaken. Even if you just look at the most basic, like without going super into the weeds, a lot of data points are turning. And to me, now is actually the time to be betting on rate cuts.
You apply, a lot of history, and that's so important to understand the history. And a lot of people are short-sighted and have, this very short term, and they have recency bias. And it's important to go back, and you're referencing the 80s, the 90s, and same thing with rates. I mean, historically, these rates aren't that high, but of course, the relativity of them, how they are compared to the recent past, they are high. I mean, look at the banking, the unrealized losses on balance sheets. I mean, we had a lot of issues with that. And now the Fed's also locked people in their homes. I mean, they have mortgage rates in the high 2s. I mean, who's going to want to sell their home and get a 7.5% mortgage? That's another, you need to have some some mobility in the real estate market. So there are a lot of issues there, and there's a lot of impetus to have this rate cut coming in and bringing them more reasonable. And I agree with your points there. Speaking of the data, I want to go into, not too weedy, but we want to go into some of this data, and you reference the soft versus the hard data, and the leading versus the lagging indicators is important. There's so much data out there. It leads us to confirmation bias. I mean, we have filter bubbles, echo chambers, and we can find anything to justify any of our narratives. Let's begin with the actual data. Let's talk about, the divergence between the soft and the hard. Are they converging now, do you think, with the business confidence? I mean, we see manufacturing new orders are still contracting. So we have those factors going on with leading indicators. Services are up. Jobless claims aren't so bad. They seem to be in line. How do you make sense of all that?
So that's a huge problem in 2024. So in the 90s or even in the 2000s, you basically had the main workhorse data like non-farm payrolls, initial claims, ISM, which was called NAPOM or whatever back in those days. And you didn't have so many alternative data sources that, like you said, if you think the economy is bad and you've thought that since 2022, I can guarantee I can find you 10 data points that will confirm exactly what you're saying. Because if you have 150 data points to choose from, excuse me, there's no world where all 150 data points are unambiguously pointing bullish. So I feel like that has become a real issue in the last few years, especially because now there's a big market of private data as well. So not only do you have like CPI, headline CPI, core PCE, headline PCE, you have Trueflation, super core, services X shelter. You can basically start slicing and dicing all these things until you just get whatever answer you want. So there's a couple of things. One, I think, is just not to be dogmatic. Like, I think there's a whole industry, and I don't think it's necessarily people doing it on purpose, but I think people understand the incentives that if you publish bearish stuff, people love it. And if you publish optimistic stuff, you don't get as many clicks, you don't get as many subscribers. And that's an empirical fact that, human beings respond to negative news and buy negative. Like if they do an A/B test of two magazines and one cover is positive and one's negative, the negative one sells more. So like people want to hear negative stuff all the time. And so I think that's probably the biggest bias in finance is the financial media, the mainstream media, individuals, Twitter, wherever you go, there's just way more negativity. And then that creates, a lot of people being underweight stocks when stocks are going to all-time highs and all that kind of thing. Now, I think it's equally dangerous to be a perma bull because then you just end up buying every like every cool story, like in 2000 or 2021 or whatever. If you're a perma bull, you're just getting more and more confident that everything's going to the moon and then to Mars. So I feel like you can't really be perma bull or perma bear. And mostly you see a lot of bearish stuff. And so getting back to the data, I think the best way to go about it is to have your workhorse data that you think matters, and then otherwise use aggregated indices that kind of combine things. So for example, Kansas City Fed does this thing called LMCI, which is Labor Market Conditions Index. And they take like 25 different data points and they probably weight them and do all these crazy PhD things to them. But the long and the short of it is that you don't fall into the trap of going, ooh, I saw it. Like, I know the economy's supposed to be hot, but I saw this one negative number over here. So let's write an article about that. The index kind of filters out that confirmation bias. And so looking at that specific index, it is rolling over and it is saying to me that the unemployment is probably going to like 4.3, 4.6, maybe even like 4.7, 4.8. And I think there's quite a few things inside that, like JOLTS is another one. The job openings there, there was 12 million job openings in the US. Now there's 8 million. And I think generally we're just transitioning from a once in a lifetime shock to a more normal economy where forever, like my entire career, everything was always about demand. So there was essentially like unlimited supplies of most things most of the time, including labor. And then it was just about demand. So what's happened now is that during COVID, there was a shortage of many things like products, obviously because of supply chains, but then there was a shortage of human beings to do work. So restaurants were closing down. So for the first time in my lifetime, it was a supply thing. And now I think we're getting back to a demand thing. So now going all the way back to your original question, the survey data if you read a textbook about economics, will say the survey data tends to lead the hard data because people feel stuff before they take action.
Mhm.
So you don't just like say, oh, the economy looks a bit crappy, I'm going to fire 20% of my workforce. Like it's very expensive to fire and hire and all that. So the actual real world actions happen way after the sentiment changes. So that's the theory. But then what happened in 21 and 22 was sentiment was just really bad because people were angry about COVID, like sort of a PTSD element of just like life sucked and my kids didn't get to have their high school and, all those bad thoughts. And then people were really worried about rising interest rates, which ended up being incorrect, but everyone was worried about a massive recession caused by higher interest rates. And then if you looked at the consumer sentiment, everyone was just super pissed about high inflation and why everything was costing so much. So even though none of those things actually relate to nominal growth, because nominal growth, actually inflation is good for nominal growth. Inflation is good for retail sales. So if everything is just the same in the world, but prices go up 5%, then retail sales are going to be up 5% year over year. So inflation was bad for sentiment, but good for for growth and good for the economy, and at least in theory. So what you saw was a huge divergence between sentiment and the real data. The real data just kept chugging the whole time, but the sentiment data was really bad. So then finally, the sentiment data, as people kind of were like, oh, they hiked 500 basis points and the world didn't end, the sentiment data started coming back, but now it's rolling over again. And I think it's completely different this time. I think it's not about inflation. It's not about rate hikes, because there are no rate hikes in the pipe. I think it's about demand. So I think it's about the 3 trillion that got pumped into the economy has been spent. People don't have that much money in the bank. Delinquencies are going up. All the stuff that you would see when a cycle is like getting a little tired. It doesn't mean that we have to have a recession, but it does mean that relative to even 2023, I think almost everything points to weaker demand. And then if you look outside of, like, you look at what like Target, Walmart, CVS, if you look a bit more micro, they're cutting prices. They're saying that people are moving to the low end. So I think overall you're just seeing many, many signs of softness. And so I think the survey data actually does matter this time, even though it didn't matter. It was a massive red herring last time in 21 and 22. I think actually it's correct this time, and it's signaling demand is weakening.
Yes, just read the April report from the small businesses, the NFIB. The chief economist was saying how small businesses are very, very pessimistic right now. So there you go, exactly in line with the sentiment getting to be very negative because of the diminishing demand of these goods. And like you said earlier, higher prices, less volume was it works fine for people. It works fine for businesses. It's less work and you get paid higher prices. But yes, the turnover expenses are high. So the sentiment, the confidence leads before the actual data is incurred, the hard data, the quantitative over the qualitative.
Right.
And so with that in mind, and you said that this might be different this time in 2024, some economists are saying the recession is already baked in, and so you're thinking maybe we can avoid a recession, however, have a slowdown in demand, have some tough times, but not necessarily be in a recession. And let's throw in the yield curve inversion with that one as well, how that's supposedly a recession predictor. So with all that, what are your thoughts with recession?
Sure. So I definitely call bullshit on the yield curve inversion.
Okay.
And the simple reason is that it doesn't necessarily have to be wrong, because it has been right basically every time. But it happened in 06, and people lost so much money positioning for the recession, which did come at the end of, or the middle of 08, that it's just not actionable. That's the problem. Is if someone says like, okay, you're going to die one day, like that's a thing that okay, that's true, but it doesn't really give you any information. So if the yield curve says there's going to be a recession, tell me when the recession's coming, and then I'll act upon it. But what generally happens is because there's such a long and variable lag between the inversion and the disinversion, which is actually a better signal, and then the actual recession, is people start positioning for recession in 2022. And now we're here in 2024, and the yield curve's been inverted the whole time. So to me, it's like, it's not quite a stopped clock, because it does say that monetary policy is tight. It has information definitely that monetary policy is restrictive, but then unless you can tell me how long does monetary policy need to be restrictive before a recession starts, then it's just not useful. And what we've learned here is that since everyone's locked in at low rates, so what happens is normally when rates go up, everyone's expenses go up, their loans get more expensive. You're trying to roll your mortgage, probably businesses are rolling 3-year debt and all that stuff. So your cost of financing your basically your liability side is going up and your expenses are going up. But then your income is usually going up less because you don't have like a ton of money in the bank and you're not making like a ton of interest and things. But in this cycle, everyone's locked in at 2.875 on their mortgage, and everyone has $50,000 in the bank these days because of all the stimmies and all the amount of money I'm exaggerating, but a lot of people do have cash. Like people are paying cash for homes like more than they ever have. So all that cash is now earning 5% interest, and people on Social Security got an 8.7% increase in 2023 because of inflation in 22. And so like all this deficit spending, the interest on this huge deficit, guess who gets most of it? Americans, right? Like 70%, don't fact check me on this, but I think 70% of the US debt is owned by Americans. So they're getting their income was zero, now it's 5% times whatever, and yet their liabilities are locked in still. So until the liabilities start going up and people start having to roll their mortgages and roll their whatever they're rolling, you can have a really long period where you get an inversion in 2022 and a recession in 2026. And unless you know within 12 months of or really 6 months, it's not very actionable. Like, how many people have bought bonds since 2022 because they thought that there was the yield curve inversion signals recession? So I'm not a fan of that as an indicator, simply because it doesn't offer good enough timing. And then generally, like economic cycles, this has been a weird one, obviously, but economic cycles don't usually last like 2 years or 3 years. So what you generally see is like some years of expansion, a soft patch, a couple more years of expansion, soft patch, recession, that kind of thing. Like it's not guaranteed that you just go from absolute boom to bust instantly. Like after the GFC, we had a boom, then 2012 there was a dip, then we had another boom, then 2015 there was a dip, then we had another boom, then there was another dip in 2019, and then COVID happened, and then we had a recession. So there's nothing written in the stars that just says you go straight from boom to bust. There's a lot of boring stuff in the middle that people don't find it very fun to talk about on podcasts, but that actually is probably the majority of the time. You got 1.8% growth and a little bit higher inflation. So I think the base case has to be that we just mean revert back to something that looks like 17, 18. And then you just go on super high alert for recession. And the thing with recession too is that you don't really have to predict it. You just have to kind of know it when you see it. And like the SOM rule is one thing that people use, which is pretty reasonable. Just generally the labor market trends and trends and trends, and then it turns. And when it turns, it usually turns like crazy. So I feel like it's more of like this isn't as helpful or systematic, but I think it's better to just know it when you see it than it is to use the yield curve inversion. And if anything, the better indicator timing wise is when it reinverts. So when the yield curve goes positive, that's been a much better indicator than the inversion.
Brent, you provide so much wise sense to all this, and I love this. I'm loving this. This is fantastic. You're
Awesome.
very just practical and realistic, and you apply like all history and your global expertise with all these, currency trading. And this is very enlightening. So, and I think it is for the audience as well. Most people are biased. There's so many cognitive biases, and, they're conditioned to think of a V-shaped recovery. They think, oh, we dropped low, we're going to go back up so high. They think in such extreme ways. And it's like, this debt is insolvent, it's all over. We're just going to, US dollar is going to lose its global reserve currency status, which highly unlikely. It's the most liquid and stable currency. That's my opinion. But it's about the in-between days, and it's about the in-between times, and it's this middle ground, these times that we should be more focused on. It's not so extreme. So wise words there. Mean reversion, agree. I think that makes total sense. I think we're always in some way mean reverting with stocks, equities, with all things. It's like a reversion to this average, this mean. So I want to take all this and apply it to the money-making side, the markets. The most exciting part of this all, is applying this global macro and all this macro thinking to actually making money from it, and then applying it to the markets. And so I want to know your thoughts on the markets. Is this just an AI-driven, just healthy bull market? Is this just a bull market, and people are just so scarred from that recent bear and all these crazy times we've had lately that they just can't believe it, and they think it's just some bubble that's forming?
Yeah, I think there's a little bit of Pavlovian aspect to it, right? Where you saw 2000, and then you saw the housing bubble in 06, 07, and then you saw another crypto bubble in 17, and then a crypto bubble and everything bubble in 2021. And it's very difficult to distinguish between a bull market and a bubble, because both of them are driven by good stories, and both of them, go up, go bottom left to top right. So it's very difficult to distinguish. I think one thing too that people don't do enough is just say, okay, this is too hard. Like, I don't know. I don't want to own Nvidia at 1200, but like, I don't really want to be short either, because if you think it's insane, like, there's no difference between 3 trillion and 4 trillion valuation. That there's just like numbers on the screen at that point. So even if someone's signing the CEO's breast in public,
Yeah.
you don't necessarily always have to be bullish or bearish. You can just be like, okay, this is too hard. Like, that's what Buffett does. He just says, you know what, this sector is too hard and I don't know, so I'm just going to stay away. Now, obviously there's situations, if you're a tech long only tech fund, then you just have to be long because that's what your mandate is. But if you're a regular investor, you don't have to always be like fully overweight the index. You can go to equal weight. You can just say, like, I don't want to be participating in this. Even if your friends are all making money in Nvidia, when it goes down, they'll all be losing money. And if it doesn't go down, you haven't lost any money. So I think people, like, there's a saying, I don't know if I'll get this right, but it's something like, other people getting rich around you is no great tragedy. And the other thing to keep in mind is that when people tell you stories of like, oh, dude, I 50x'd on Zoom calls through earnings or whatever, they're only telling you the ones that they won on. So just don't worry about it so much. Like, I feel like people feel like they have to be bullish or bearish everything all the time. And sometimes you can just say like, oh, look at that thing over there. That's interesting. but overall, I do think that it's better and easier to lean bullish, simply because there's so much negative stuff out there that you're always going to get fed tons of negative stuff. So you'll always know the bear case, but what you want to do is be educated on the bull case and then kind of make your decisions and your arguments. I feel like this is more like not investment advice, because I'm not an investor, but as the world, the way that I see the world, having lived through .com and through 2021, is that the risk reward of owning mega cap and overweight things is really shitty. And I would rather just own equal weight, because I don't think you want to be short stocks. You just want to recognize that passive investing and indexing can create absolute behemoths that can feed on themselves like a snowball rolling down a hill, and just get bigger and bigger and bigger because of the nature of the way that indexing and passive works. And it doesn't mean that they're wrong, because those companies earn more money. Like, people are like, oh, Microsoft's bigger than the whole Canadian stock market. Well, guess what? Microsoft's net income is bigger than the top 30 companies in Canada combined, including like RBC and TD, which are like massive money making machines. Microsoft makes more money than all of those. So these companies make a lot of money, but it doesn't mean that you have to be long or short all the time. You can just say like, hey, this seems pretty crazy. I'm going to step aside. It's too hard, and I'll just be equal weight. And also now you can even go back to 60-40, because I don't think bonds are going to be horrible either. So I feel like stepping out of the way of the real crazy stuff like AI doesn't really hurt you that much. And it's okay to just be like, I'm stepping aside. If all my friends make money in that thing, that's fine. And I'm just going to be in like a bit of crypto, bit of bonds, bit of equal weight equities, and I'm going to avoid things that are trading at 40 times sales.
You got to do what works for you. And the most important thing of that is ignore the noise and the chatter from other people, because they only tell you what they want to tell you and not the other side of it.
Yeah.
And who knows how many losses they might have taken on shorting Nvidia, and they don't tell you that part.
And
But
this is like such a simple thing, but it's applies to trading and investing. But I think just thinking rationally is such an edge, because so few people are thinking rationally, at especially at the extremes. And like, that's what Jim Simons would say, is like, it's the emotional extremes where all the money's made. Or like Platt from Blue Crested, like, all our money is made mopping up after the explosion, or something. I forgot the exact quote. So there's an element of like, just stand back and whatever you're doing, whether it's trading, investing, or whatever. And I try to do this like in almost like a weird way where I try to be outside of my body and imagine myself watching myself and say like, okay, is that guy doing something stupid, or is that actually like a positive EV, positive expected value action that that person's taking when I'm referring to myself? And I think just doing that keeps you out of certain traps like, oh, my friend bought this thing and he's making so much money, I got to buy it too. Like if you're doing that and then you're actually stepping back and saying, okay, am I thinking rationally? No, that's purely an emotional decision. Like I have no idea what that company even does. So I think just maintaining rationality is a huge, huge edge. And there's this one chart I don't know if you have show notes, I could send it to you after, but it's an absolute, you might have seen it. It's mind blowing. So it shows 1995 to 2014, total return of all the different asset classes. So it's like stocks, 8%, this, whatever, real estate, 10%, bonds, 5%, blah, 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 all the way across. And then they looked at 2 million Charles Schwab accounts and checked what were the actual real life returns in those accounts. And it's like 3.1% annually. So those accounts underperform literally every single asset class. And it's because people are selling at the lows and buying at the highs. And like when 08 happened, people are like, it's the end of the world, I got to sell. And then by 2011, they're like, whoops, actually, I guess everything's okay. And then 2020, oh, it's the end of the world, I got to sell. And so if if you can just maintain rationality, whether you're short-term day trading or investing on a 20-year time horizon, I think you'll outperform like 96% of the world simply just by being rational.
Well, you're certainly very rational with the way you apply your thinking to the macroeconomics as well as the market, Brent. And I like that third person, like looking at yourself and stepping out of your body and looking at what you're doing and your actions. You know, I had a great guest on here once named Tom Basso. You might have heard of him, the all-weather trader.
Yeah.
He said the same thing.
Oh,
He said that
interesting. Okay.
he would get out of his body, he would look in the mirror or something, and he would just be like, he would looking at what he's doing and as a third person. And I think that really works. I think it's a great approach and a great strategy for people to try. Because
Yeah, I got that from some like self-helpy kind of book where it was like when something really bad happens to you and you're really down, think about yourself as a character in a novel and then think, ooh, what happens next? And that's, I think, is a cool framework of like dissociating a little bit with the drama of what's going on in your crazy head and trying to dissociate a little bit and look at it more objectively. And I think it applies to a lot of things, like not just to trading and investing.
Well, life mimics trading and trading mimics life, and a lot of the life lessons and wisdom you can apply in trading and vice versa. And I learned about myself through trading. It's like, whoa, I didn't want to know that, but I know that now. But yeah, disassociating yourself from these emotions, and most important, when you enter a new trade, to go with a clean slate, not to take the emotions of the previous trade into the next. A lot of revenge trading goes on, and that's how people can compound their losses. And then, I had another guest on here that said, I like to buy stocks when everyone's throwing up. It's like you want to buy when you want to buy low and sell high, not the opposite. And our human brain is almost like conditioned to do the opposite, is to sell low and buy high, because everyone loves Nvidia when it goes over 1,000, right? I mean, it's just the greatest ever. But when it pulled back to 700s, 800s recently, it's like a lot of people are like, oh, I'm not going to touch that. They're afraid. And it's just that it's like, actually, that's the time to buy. And now is when it's getting a little high up there and you get to be more cautious. So applying
And
rationality.
it's an incredibly difficult thing to do because the other side of that coin actually is just as bad. So when I started in finance, I thought of myself as being a smart person. And I think I had like an ego that wanted to be smarter than everyone else. And I wanted to prove that I was smarter than everyone else. So I wanted to be short when everyone else was long. And I was like, I'm a contrarian kind of thing, which like I wore as a badge of honor. This is in my 20s. And then I realized you just can't make money doing that either, because you're always fighting every single major trend. So I think you have to have a really good mix of trend following and contrarian at the right time. You can't simply just be contrarian all the time. And you definitely can't just ride the trend all the time. There has to be some kind of combination of ability to say, this is a good idea and a lot of people are embracing it, but we're in the early innings. And then this is a good idea and everyone's embracing it. And this is like the bottom of the ninth inning, to use the baseball analogy. So, and distinguishing between those two things is very difficult because things go farther and faster than anyone ever expects. So I think that really is one of the fundamental challenges of trading and investing, is being right before everyone else agrees with you, and then also getting out. And the one good thing that makes investing sometimes a little bit easier is that your exits don't have to be perfect. You can sometimes, I mean, some people just buy stuff and never sell it. And that's not a totally unreasonable idea in a world of rising deficits and fiat debasement, that anything that's nominal in that world will tend to go up. So you want to always have a long bias overall. And you see that too, right? Like the short funds mostly in the long run don't do that great. They have their moments in the sun, but you're fighting so many things when you're short. Like when you're bearish, you're paying for the borrow or however you're doing the short, or you're buying puts, which are always expensive. You have limited amount of money that you can make because a stock can only go to zero and an index can never go to zero, but a stock can go up 10 times and an index can go up 10 times. So you're creating all these asymmetries. You're just basically making it really hard on yourself if you're always bearish. And again, like I'll be short individual stocks and be long this and short that. And I'm quite flexible. So I'm not saying like just be a perma bull, but being short is really hard and being long is much easier. So you have to kind of choose what game you want to play and pick the right game, and then be flexible enough to switch here and there if you need to.
Wise words there. Definitely great thinking there. Thanks for sharing. Now, you said this twice already, currency debasement, and you said it earlier in the show. So before we go on, I'm going to talk about your South Park indicator, which is exciting with the obesity drugs. I want to talk about this currency debasement. So eventually, with this massive debt that we have going on, it will help other assets. You said Bitcoin, you said gold, and you said asset prices. So are you bullish on those long term?
So structurally, yes. If you're investing long term, it's generally better to have something that pays a yield because of the magic of compounding. So that's why I don't really like gold, because it doesn't have a yield. It's not as volatile as Bitcoin and equities. So historically, equities are just a way better hedge for this kind of fiat debasement. And also equities have a drift. So earnings tend to go up. The economy tends to grow. There's dividends, there's buybacks. There's a lot of factors that create a positive drift in equities. And there isn't really a positive drift in gold other than just nominal prices of everything go up over time. So that's the drift in gold. So I'm not a big fan of gold. I just feel like there's almost always a better thing. Whatever you're trying to do with gold, I feel like there's almost always a better thing. The only time gold is good is just like as pure defense. If you bought gold in 2000 with stocks at the highs and gold at the lows, that was an amazing trade. But there's very few times when gold is really an amazing investment. And I don't feel like after this run that it's an amazing investment. I would rather have things that have more leverage to debasement and are more volatile. If you think that fiat is being debased, you're better off being long more volatile things like Bitcoin and stocks. And I will say all of that is structural though. And I do sometimes think like throughout 2022, I was pretty much always short everything in long dollars, because whatever you think in the bigger picture, the Fed slamming on the brakes is going to be some kind of cyclical stop to the structural thing. But you can see like as soon as the Fed stopped hiking, essentially all the stuff started appreciating again. And I think a lot of that's just a function of deficits. Now, one question around that, which isn't really timely, but will be at one point, is when the election happens. If Trump wins, presumably it's going to be more fiscal stimulus, tax cuts, the same thing he did in 2017. But if Biden wins, I don't think it's quite as obvious, because he's been burned by the inflation I think most people agree that his approval rating, some part of the crappiness of it is from the inflation and the anger around inflation. So, and then the TCGA, which was Trump's thing, expires in 25. So I don't know if it's quite as obvious that this goes on forever. If Biden wins, I could see in 2025 that fiscal contraction actually begins a little bit, and that's a completely different story. So I never like to extrapolate everything forever, but it's pretty easy to extrapolate this sort of MMT fiscal craziness thing out as far as the eye can see. And then I guess you just keep an eye out for maybe it won't go on forever, just like it didn't go on forever in the 80s.
Yeah, in election year, so definitely, and a lot of views are very political these days. So it depends on which way we go. But yeah, that salt tax definitely affected us in our area here with that Trump passed that, and it's expiring in 25. We'll see what happens
Actually,
going
and there's an
forward.
interesting point you made about the dollar. So I get into debates about this all the time because like I'm an apologist for the dollar, but if you look at what's actually happening in the world, usage of the dollar is going up. Like Argentina, Turkey, the places where things are sketchy, the usage of the dollar increases. And so Bitcoin, again, crypto, the entire crypto ecosystem is based on the dollar. Like there's no tether. Well, there is actually, but nobody's transacting tether against the euro or tether against Chinese yuan. It's the dollar is the anchor for the global financial system. It's the anchor for the crypto system. So, and then if you look at transaction data, there's never been a time where more transactions were done in US dollars than right now. So I'm a big anti-de-dollarization person. Like I don't think there's any cohesion between Brazil and China and Russia to create any kind of alternate system. Literally, I've been hearing about this since 2003 or whatever. I've actually posted these headlines of like Iran's going to price oil in Chinese yuan from 2004. And it just doesn't move the needle. Like the dollar, if you go anywhere in the world, people will accept dollars. They're not going to accept Chinese renminbi. And that's not going to change. So, and the other thing too is that, so that's why I always say fiat debasement is that it's not like many countries are running these super prudent fiscal policies. They're running more prudent than the insane US policy, but they're not that prudent. So generally there's fiscal expansion going on in a lot of countries. And so I view more as like the dollar is the standard for all transactions in the world, and that will not change. And then there's a lot of money being printed all over the place. And so the real de-whateverization is de-fiatization, where people want things that are not priced in fiat, like gold, Bitcoin, equities, basically anything, real estate. When there's debasement and it's not out of control, it's just bullish for everything.
Dollar. I'm going to say king dollar.
Yeah,
the
it's not
US
bearish dollar, that's for sure.
No, it's the king dollar, and it shall
Yeah.
remain as the global reserve currency, most liquid, most stable, and it's the one and only US dollar. And there's been a lot of talk about energy or oil being priced in Bitcoin. Do you think that's possible in the near future?
I honestly, I don't think it really matters because all these currencies can be exchanged for dollars anyways. So say Saudi Arabia sells, oil to China and China gives them Chinese yuan. They're not going to hold it. They're just going to sell it and buy dollars anyways. Like all these currencies, I feel like there's kind of like this understanding that the whole system will be changed by these transactions. These transactions have been going on for decades now. Like China's a pretty big a pretty big financial center, and a lot of the transactions there happen in yuan. It just doesn't matter. Those yuan are just then exchanged for dollars because nobody wants, like, so if you look at percent of global central bank reserves, China's gone from something like 2% to 6%. And the US has been steady and the euro went down. So if anything, the substitution has been out of euros and into Chinese yuan. But overall, the transaction volumes, if they go from 3% to 5% to 7%, it just doesn't matter. Like it's like whether the Texas Stock Exchange will compete with the New York Stock Exchange, and they might take 7%, but 20 years from now, I don't think people are going to be trading like moving to Texas to trade on the Texas Stock Exchange. The sort of incumbent will last a long time. And the thing is, there's no evidence that the dollar's actually losing its status. In fact, the only evidence is the tweets from people that have been believing that since 2005.
The tweets, I don't know how much we put into those tweets. I guess they're funny to read sometimes. I like that point that you made about currency debasement, fiat debasement. It's not US dollar, it's fiat. It's the actual money that has it's not backed by gold or other real assets. It's a government guarantee, but fiat debasement, an important point there. So obesity drugs, you put out an article, a great article with the South Park indicator. I guess once it's on the show means that item, that stock will underperform over the next 12 months. So what's going on with this hot market, LLY, NVO, Viking? Do you think they may underperform because of South Park?
So I don't know anything about the science. What I deal in with this stuff is more behavioral clues. And I feel like behavioral evidence should never be like your entire methodology. So I'm throwing this out as like it's a fun indicator, but also it has validity, because the logic behind it is that if some financial or corporate theme is on South Park, by definition, it has to be pretty priced in, right? Like there's no, up and coming company that no one's ever heard of is going to be on South Park. It's only the massive companies that everyone's talking about, because the whole point of the show is to capture the zeitgeist and reflect back the insanity of the human, whatever, like same as Black Mirror. It's like the funny version of Black Mirror. So if a company is on South Park, by definition, that company has been receiving an enormous amount of media attention, and that enormous amount of media attention will be reflected in the stock price, that a lot of people bought the stock because of people buy stocks on media attention. That's like an empirical fact. So at peak media attention is a time when you should be most concerned about being long something. And it's the same as the magazine cover indicator, which I've back tested as well. So when something appears on the front of the Economist magazine, that's a reverse indicator. And it's the same concept, is that once a non-trading or non-markets magazine, so Barron's is not a reverse indicator because they're just talking about the market all the time. But what you're looking for is people outside the market talking about market stuff. So like Time magazine has Elon Musk on the cover, and then Tesla goes down by 50% after that. And it's a similar with the Economist cover. Like crypto's downfall was the headline on the Economist when Bitcoin was at 16,600. And it's not a coincidence. It's reflecting that the zeitgeist is a certain way. And South Park's the same thing. So I did a back test. The sample size isn't huge because like not that many companies have been on South Park, but I think there was like around 30, because the show's been around for a long time. And on average, those companies' stocks underperform the S&P by 7% in the following year. There's quite a bit of dispersion, but I think it's interesting and it's logical. Anything that I do a lot of back testing and like, hypothesis testing. I have an idea and I just test it. And only if the data and there's some logic and they both go together, then I'll talk about it or write about it. And in this case, it's kind of a fun thing, but I think it's also logical, and it does back test pretty well too.
And it's fun. It's actually really cute and it's funny. I like that. South Park indicator is very catchy. That's a great point. I love that. It's just part of your flair that you have. I love that. Just like your upside down name for Twitter handle. Very, very fun stuff. Now it's like balancing, like you said, the contrarian with the trend following. And I always try to do that. And we're always working to improve. And there's a great Ken Fisher I'd love. I mean, great billionaire. He has great books about that as well. So with NVIDIA breast signing, would that be like peak media hype, would you say?
I mean, if you're a behavioral person and you're looking at that, there's no way you can be long NVIDIA at these levels. I mean, the thing is too, is that going kind of back to my thing about sidestepping these crazy things, is that sure, it could just keep on going up. There's nothing, like, things are not predetermined. Everything is probabilistic. But if you look at all the stocks over the last 20 years that traded at 40 or 50 times sales, they were shitty bets in aggregate, but doesn't mean that every single one of them was a bad bet. So you're essentially stepping aside from a negative expected value trade, in my opinion, and that's okay. And if Nvidia goes to be worth $300 trillion and takes over the universe, who cares? That doesn't actually cost you anything. Yeah, there's opportunity cost, but I
Mhm.
think people get so worried about like the FOMO aspect that they do a lot of irrational things where, if you think it's a great company and you think it's fairly valued at $3 trillion and you think it's going to 6 trillion, then go for it. There's nothing wrong with that. But just understand what your motivations are and think about what your motivations are and why are you buying it, or why are you shorting it at this level?
Yeah, it's like asking yourself as a third party those questions and
Right.
why, and being logical. And that's
Mhm.
very important to separate. We're all emotional beings and we all feel emotions. We feel, but it's important to separate the decision making from that emotion and being logical with that.
Right. And
Um,
like, I'm not some kind of robot. Like I make millions of stupid mistakes and I overtrade and I love gambling. So it's not a matter of like turning yourself into a robot. It's more a matter of just feeling whatever you feel. And then recognizing it and going like, even just when you are walking into your house, thinking about like, how do I feel right now? Am I frustrated? Am I angry? Or whatever. That's the same thing with positioning, or with positions and with trading and everything. It's not a matter of like squashing your emotions and being like a 1950s, person who is just doesn't feel anything. It's just about recognizing how those, like you said, how those emotions could potentially impact your decisions because, a professional athlete shows plenty of emotions, but those emotions can be powerful or they can be detrimental. And it sort of depends how the person incorporates that into or controls that and uses it or doesn't use it.
it's about life skills, using that EQ they talk about
Right.
and applying that to trading. Yeah, very important stuff. So I want to know about your thoughts on energy. Everyone's saying energy is going to run to the end of the year. You have so many different views here, and the contrarian says that it's selling off and it may run. How do you look at it? How do you look at this energy, oil, and uranium market it's in a massive bull. Some people say it's a bubble, who knows? But what are your thoughts on all the energy oil plays and now
So
solar?
I will use this opportunity to say it's okay if you don't have an opinion, and it's okay to say I don't know. And commodities are just outside of my wheelhouse. I know that's your wheelhouse, but it's really
A
quite
little.
outside of my wheelhouse. So the only thing I really watch is just I look at them as demand indicators. If you can strip out and there's no supply issue and the thing's going down, then you may say like, okay, oil is a key input into every inflation and every central bank outlook. So if oil's going down, that's disinflationary pretty much by definition, at least on the headline side. So I watch commodities as an input into my macro view, but I
Mhm.
don't predict them because I just feel like I have no edge whatsoever. And nor have I ever had an edge in commodities.
I like that. They're an input for your global market, global macro analysis.
Right.
Very important there as well. So, okay, bond market. I want to go through, you have a great article that you wrote, and I urge everyone to check out your Spectra Markets because it's global macro, but it's really fun. And I really enjoyed reading this article about how you compare bond market movement to viscosity. And you say how volatility is more important than direction. And I want you to tell us about that. And they're extremely slow, like molasses pre-COVID. And I guess you referred to as high viscosity. And then you have extremely fast, I think less than one in the 22 to 23. And now it's also risen in viscosity higher than one, which is water. And now it's more like maple syrup. So tell us about all that.
Sure. So the references to bond yields and how fast they're moving. So pre-COVID, they were like molasses. Then they were like completely insane. And now
Mm.
they're like, still moving around, but more like maple syrup. And in the course of investigating that analogy, I did learn that peanut butter is 150,000 times more viscous than water. So there you go.
Mhm.
But but the point of the whole thing is that it's not so much about where yields are going when you're looking at asset prices. It's more about how fast they're moving. So in 2022, the cone of uncertainty was super wide. No one knew how fast rates were going to go up, and they were going up fast. They were hiking 50, they hiked 75. And that was coming from a place where people were used to like 25 basis points every quarter or whatever. And now they're going like 50, 75. So that's scary. How does a market adjust for that? There's so much uncertainty. And then what happened was then rates peaked, and then volatility kind of stabilized, and then rates started going back up again. Yields started going back up again, but in a very non-volatile way. And so when yields started going up, everyone started selling the stock market. But what the reality was that if yields are going up slowly, it's actually not that scary. And everyone just then started buying their stocks back. So in the end, it's the volatility of the bond market and the uncertainty, which is reflected by that volatility, that actually matters for risky assets much more than the direction of bond yields. So if you know, okay, the Fed's not going to hike, so that whole side of the distribution is gone. When yields went to 5%, Yellen changed the mix of bills and notes to crush yields. So again, you know, that part of the tail, again, that's a top side, a little bit cut off. You know, inflation just went from like 8 to 3%, and the momentum in goods is still disinflationary, and services is nah, but you're probably not going to get like exploding higher inflation. So everything kind of leans with a little bit of a skew that way. And I think that's, knowing that makes it easier for the bond market to like not be that scared. So even when yields go up, it's not like this end of the world situation like 2022. And so I watch a thing on Bloomberg called the Move Index, which Harley Bassman is invented, which is kind of like a bond market version of the VIX. Essentially like kind of looks at 1 month bond market volatility. And you always have some kind of combination of volatility and yield direction that determines things. But the real like kryptonite for markets is high volatility, rising yields. And that's what we got in 2022. And stocks obviously responded to that. But in 2024, we got higher yields, but volatility never picked up. And so, you know, it remains unicorns and lollipops.
So a lot of talk about people going long TLT now, thinking that yields may be coming down. Is that something you're looking at? Is that how you would play this bond market?
I think it depends on a lot of things, but as a US taxpayer, munis generally, I think, are almost always better just because of the tax treatment. Not a financial advisor, but that's my view. But I do think in general, the skew, for all the reasons that I've kind of been saying throughout the show, the skew is definitely to lower yields. So I think yields either kind of go nowhere or they go down, but I don't see them going up a lot. So to me, that means owning bonds is a good idea. Owning even like T-bills or munis or whatever things you like, I think are all pretty good. I think people kind of forget, like a couple of years ago, you were getting zero on all your fixed income assets. 5% is not nothing. Like if inflation's 3 and T-bills or 2-year notes are 5, you know, that's 2% real yields. That's pretty good. That's actually not bad. So like there's this idea that like the purchasing power of the dollar is collapsing or whatever. It's not. Like if you have a dollar in well, not in every bank, because some banks are still ripping people off with 0% yields. But if you have money in a bank where you're getting 4.5% and inflation is 3%, that's a positive real yield, and it's not horrible. So I don't mind having a little bit less money in like mega cap, and a little bit more money in fixed income, simply because I think the margin of safety is pretty good now. Like at 5% yields, you're not really in a bad position. And it depends on a lot of things. Obviously, I think as you get older and as you have more wealth, it pays to be more conservative and have more money in fixed income, because the next whatever, like say you're whatever you're worth, the next million is never going to give you as much utility as the last million. So the more money that you actually have in terms of wealth, the more conservative I think you should be, because of the diminishing marginal benefits that you get from getting more and more money. So losing, if you go from 0 to 1 million, going back to 0 is horrible and painful. but going from 1 million to 2 million isn't actually going to make you that much happier.
Very wise words there. Very rational thinking. That's so true. With that, munis are great. I like them myself. Positive real yields of 2%. That's significantly more than what we had in our recent past. So everyone always thinks they want to go elsewhere, but they're actually, your money is actually getting a return now, unlike before. And diversification. I always tell my clients and people diversification is key. So you don't have to be all in the market. You can have some munis, you can have some, like you said, 60-40 might not be so bad, so you can have a diversification of your assets and not just all in one place. And I like that myself. So now currency trading, FX trading, we're going to end on this topic. And I wasn't going to let you escape without you teaching us a little bit about this. Currency trading on your website, I read this right from Spectra Markets. It's about predicting divergences between country performance. That's a very complex topic. I mean, that's very complex for most people, I think. And you have to understand so many different variables. And you're an expert in this. And this is so fascinating. So it has to do with pairs as well. I think you were long the euro US dollar trade. I don't know if you're still long that. If you could tell us your thinking when you go into these trades and how you view this and your euro US dollar long.
Sure. So this is an incredibly complex topic. Obviously, I've written in a couple of books about it. But I'll boil it down to a couple of minutes. So generally, money flows to countries where rates are higher so I'm only going to talk about G10 because emerging markets are different. Generally, when rates go up in emerging markets, it's sometimes scary because it might mean that there's a credit risk situation. But in G10, generally, if yields are going up, money will flow to that country because people want to get a higher yield. So bond market investors are going to go the place where if Australia is yielding 5%, and Canada's yielding 3%, all other things being equal, people are going to put more money in Australia. So generally, that's like a fact that exists mostly throughout my entire career. So what you're looking at is like, okay, what country, forget about what the levels are, because the levels are just the levels and those should be priced in. But what countries' rates are going to go up more over the next period and which countries' rates are going to go down more. And so what I was feeling, I actually exited the trade today before ECB, but the point remains the same, that I was feeling that the US data is rolling over at a time when expectations for Europe are still very, very low. And actually the European data has been improving. So you have a divergence in the data, and generally that type of divergence will then flow through to yields and it will flow through to FX. So if you can predict which countries are going to do better over the next 6 months relative to expectations and which ones are going to be worse, then you take the ones you like and you put them on top, and you take the ones you don't like and you put them on the bottom. So say, for example, I think the Bank of Canada could keep on cutting and yields are quite low in Canada now, relatively speaking. And in Japan, they're just starting to hike, and like Japanese yields are going up. And I think that's going to continue. And I think I'm just saying that theoretical, and Canada's housing market's vulnerable and all this kind of stuff. So then I might short Canada and long yen. So the fun part of FX is that there's always two sides. It's kind of like relative value trading. And ideally you have like a country that you're really bullish about, and you have a country that you're really bearish about, and then you match them up. And then you can do different things. Like if I'm bullish Canada, but I don't really have like a bearish place, I might just buy Canada against 5 countries or whatever. But generally what you're looking for is like, I love this economy, or I love this story and I hate this story. And then I'm going to go long one and short the other one.
Fascinating. Are you bullish any country right now?
I'm actually bullish Europe still relative to
Really?
expectations, because expectations are so in the toilet. And I mean, especially the currency, because wage growth has been pretty good. And actually most of the data has been okay in Europe. And people just have this permanent view of like, Europe is a shit show with no good companies, which, I mean, there's some truth to it, but it's not always true all the time. And there can be cyclical moves in the currencies that move 10%. So I try not to get too hung up, even like with the US deficits thing, like a lot of the stuff we've been talking about. I try not to get too hung up on structural stories because they just lead to very inflexible thinking. And generally, markets respond more to cyclical things, and structural things are like burning sort of slow burners in the background. But it's the cyclical stuff that really makes markets move.
Well said. Thank you so much, Brent. This has been amazing. I could ask you a million more questions, but we'd be here all day. So we'll stop here. Thank you so much. I want you to please share with our audience how they can follow you and how they can check out your Spectra School.
Sure. So spectramarkets.com. So it's SPECTRA. That's my website. And then we just launched actually 3 days ago, Spectra School. So that's the same website / school. And the point of that is the first course is called Think Like a Market Professional. And really like many of the themes that we've discussed here would come up in that, which is being pragmatic, understanding how markets really move, not looking at theory, not looking at like discounted cash flows, and then saying like, why is Tesla so expensive when discounted cash flows value it at $30? Well, the answer is because there's narratives and there's cycles and there's many other things that go into the price. So it's about the genesis for Spectra School was I went to business school and did economics. And then like after 4 weeks on a trading floor, I was like, I know more about markets in these 4 weeks, or I learned more about markets in these 4 weeks than I learned in like 2 years of economics and business school and all that. So the idea is to kind of create a bridge and go beyond theoretical and teach people how markets actually really work, and on a level that's sophisticated enough that someone like an RIA or someone who's been in the market for 5 years would still appreciate it, but then someone who's new would also learn the basics of how markets actually work.
I love that. Love that, because there's such a divergence and disparity between the theory and the real world trading. And you're able to bridge that. And I hear you answer the existential question of what really makes stocks go up and down.
Yeah, well, that's the idea. And actually, you kind of referred to, so we got this sweet video made. I love doing creative stuff.
Yeah, I
So
can tell.
there's nothing more fun than like writing a script and then seeing it come to life. I actually had a cartoon on TV in Canada for a couple of years.
Really?
But so I wrote this script for this, like it's a short video. It's on the website, spectramarkets.com/school. But one of the points of the video is like, there's 3 ways to learn markets. You can learn from like CNBC and like academic professors. You can learn from influencers and like people taking selfies of themselves in front of Lamborghinis, or you can learn from Spectra School. And I think there's some validity, like it's kind of presented as a slightly funny thing, but I think there's some validity in learning from actual market professionals who have traded. Like I was a market maker, I traded retail. I've, spent my whole life trading, learning from market professionals and not from theoreticians or from like 19-year-old dude in Serbia who's, really famous on Instagram.
Well, you're very pragmatic. And I have to say, in economics in graduate school, I remember doing so many calculations with CAPM and then the FAMA French and all these indicators. And I got to tell you, there's that human emotion, that behavioral economic element in that doesn't capture. And there's just so much that you learn from the real world trading and learning from others that have been doing it as long as you have. So
Right.
I have to say, yeah.
Sorry, I don't
No,
poo-poo the theoretical side. Like I feel like that's kind of the scaffolding that you need to understand markets. So we don't totally ignore that either. We do some of that, but I think the holy grail is combining what you're describing, like the behavioral narrative, that kind of stuff, and the stories with a good fundamental and like data driven approach. But the holy grail is combining both of those. And a lot of people tend to do one or the other. And I think really to succeed, my experience is that you need to do both.
Absolutely. It's all interconnected. The world is actually interconnected multiplayer. So it's just like that with our trading. We need to connect all elements together to get a better decision-making process. So thank you so much. And spectramarkets.com. And Brent, this has been fantastic. Thank you.
All right. Awesome. Nice talking to you.